All right, great. Hi, everyone. I'm speaking to the world famous MG Lux today. Uh, a good friend of mine. We actually met once. Um, and because we have a lot of thoughts in common, but also some differences, we thought it'd be great to have a little chat for your benefit. Talk about investment ideas, market opportunities, what's going well, what's not going well, and put the content out for you guys on this slow Friday. How are you, Marcin?
Hi, Hugo. Thanks very much for the introduction. Yes, looking forward to this catch up. We had a fantastic chat in Barcelona not so long ago, and it's always great to talk stocks with you, especially we have a slightly different approach. And like I said, we agree on some things very clearly, and then we have a different outlook with slightly different strategies. So I think this will be interesting for the copiers, especially who are looking into our thought process and some decision making.
Mm. So the way we're going to structure the call is we're going to start by looking back to the first 6-7 months of this year. What went well, what went a bit less well. Then discuss our outlook for the rest of the year, and I suppose we're going to agree on that. And then each of us will sell the top 3 investment ideas. So keeping the best part for the end of the call.
Absolutely.
Yeah. So do you want to start? Last 6 months.
Sure. I can start. My story is probably more boring and simpler than yours. So I'm looking actually forward to hearing yours myself. So I had a massive head start this year, as I made 20% in January. So it was one of the best. Well, I didn't invest in GameStop, but actually stocks that sent me 20% up were mainly the small caps. And I'm quite well known in the community for Asensus Surgical. It used to be, the ticker used to be TRXC, but the company then rebranded to ASXC. And it's basically a robotic company. And they operate on stomach and things like this. They help the surgeon, and they are capable of performing minor surgery themselves. And I made 1,500% on it, most of it in January. And then I also had Bionano, which also made similar. And I guess I've been watching the share price and the movement closely enough to be able to take profit over, I think I had about almost 10%, and I trimmed it to 3. And this kind of locking in the profit from these trades were crucial for me. So I had a big January. Then the February was also quite big. So I think I was sitting at 37% or something like this until around mid-Feb. And since then, it hasn't been that easy. So, I didn't close those positions. It's kind of difficult even if you make 15x and if you believe in them long term, you still want to have some exposure to them. But, a census would go from 6.5 in Feb to 2.2 right now. And Bionano is also half of the price. So this has then impacted my performance since February. I'm not as bad as Cathy Woods, but I'm still about, I think about 12% off the all-time highs. So I've been about 5% up on a few months, and then I had a really bad July because I loaded up. I actually started July with almost 40% cash, but I deployed to China too early. The opportunities to look great, but obviously the regulatory framework and Chinese companies kind of clamping down on their businesses, it has been quite difficult, which I look at it as an opportunity. So I know we often talk, you like a 20% upside safe stock, and I'm more like 100% upside volatile stock, and probably bring us in a similar result. But I just kind of like to have the peace of mind that I know I'm buying a business half price, and even if I have to wait for 2 months or something, I'm prepared to do that. So bad July, and now I'm picking up. I think I'm in a really good space for growth now.
Yeah, I was thinking about it the other day, and you operate a little bit like a venture capitalist. No, you go for the really high risk, but also very high reward opportunities, and you spread it around 20, 30 stocks. So even if 10 of them go bust, you only need a few winners to really have great returns. And that's what you've done this year. No, Census, Bionano, and others. You can't afford to lose 5, 10 stocks. It doesn't really matter. And I like that attitude. I think it's a great long-term view. I think it gets really good results. Obviously, it's not really adapted for the eToro copier that comes and then sees red for 2 months and then leaves. But that's their fault, not yours.
Yeah, absolutely. And I think it's quite different to other popular investors. So there's a little bit of a differentiation here. And, having found a census, now there's a little bit of pressure. People asking me, what's next? Is
What's
it
the next?
Boxlight, IRO? But I also feel I have the tools, to analyze those companies really well. So that reduces the risk to some point. And as you said, the diversification is an absolute key. Even if you think you have a gold mine, it can go the other way, especially in the biotech space. So you need to be careful and diversify. So what about your story, Hugo? Tell us about your 6 months.
Yeah,
So,
it'd be actually almost the opposite as yours. I think back in last September, October, I really saw an opportunity in small caps, and especially on the value side. And I went really overweight there, which cost me a little bit at the end of October and put me in the red, but then it caused me to have a really great November, December, and early Jan. And then I sort of thought, okay, this is getting a bit overheated. So I trimmed down in early January all my small cap positions to profit. And that's exactly when the whole meme stock
yeah.
trend happened and all of us small caps starting to just explode. So I was really jealous to see you guys with like 10%, 15%, 20% return. Whereas my January was like 3, 4%, and then February 3, 4%, which was still beating the market, but like not beating
Sure.
other PIs. Um, and that was a sort of like, risk management decision that I thought it was getting overheated. And I think it was the right call, but like 2 or 3 weeks too early.
Sure.
Um, but then thanks to that decision, I didn't have such a massive drop in February, March, like other guys had. I actually had all of my month in green. I was never more than 4 or 5% of my all-time high. So that was good. That was just steady growth. Um, and so that went much better. Like March, April went well, and then I think May was actually my best month.
Okay.
Where like beginning of the month, we had a pretty deep correction in small cap names, and I was kind of away from them, so I didn't suffer too much. And then middle of the month, I thought, okay, that's way too much. Like there was some stocks like Enphase was trading at I think $115.
Yeah.
A lot of like small caps never really, really discounted. So I went back to small cap pretty heavily at that point. And I ended May up 5, 6% when the markets were actually down for the month.
That's great.
That was great. That was like really good timing. Like my timing was really poor in January, but in May was great. And that continued through June, beginning of July, and then small caps corrected again.
Right.
And I had the same. I had a 7% drawdown, which was a bit painful, and everything collapsed at the same time. Small
Yeah.
caps, China, value
Yeah.
stock, everything down except big
Like,
tech. That was painful. But it's as you say, I think it's an opportunity. I'm super bullish for emerging markets for the next 10 years. I think they had a pretty rough last decade overall. And I think the next decade is going to be for emerging markets. And so I really started building a position in July, which I think is going to do really well. And I went back overweight on small cap, which I think, is very volatile at the moment, but I think it's going to do really well in the next 6 months. So
Sure.
I'm overweight there again. Yeah. So
Yeah, I
overall,
agree. Yeah.
yeah, and I was going to say overall, slow and steady growth, but up 20% for the year, not too bad.
Yeah, we were sitting at a similar result, but like you say, a little bit different distribution. Yeah, I'm also quite, I'm very bullish on the small caps because basically they've been hurting since February. And a lot of them really see it at either half or a third of a price. And they kind of lost the momentum of, there's no really reason of going down. And I'm seeing some of them reporting, earnings just on the spot, and then going maybe 5% down pre-market, but very soon 7% up or so, because it's just a reversion to the mean. If one of the stocks I like the most now is Boxlight, so I know we'll go to free stocks, but it's trading at a third of fair value, and even if you assume it's half, even if you assume 50%, it's just such a great position to be. And you can see for now few months it's bottoming out, so then the risk reward is very, very attractive.
Yeah, I have the same view on small cap. I think it maybe went a little bit ahead of itself until February. It was too hot, and it corrected, as you said, back to the mean. But I think we're bottoming now. And when you look at the data, unemployment data, you look at growth, you look at customer saving, you look at the housing market, you look at all the tensions that are in supply chains, the cost of containers from China and semiconductors. It's really hot everywhere, and the
Absolutely.
constraint is on the supply side, I think, more than the demand side. Demand is exceptionally strong.
Yeah.
And so that tells me that we're going to have a good next 6 months in terms of the economy and the stock market. There's a lot of demand in the economic system at the moment.
Absolutely. I think yesterday we had Goldman Sachs revising S&P to 4.9 from I think 4.4 or something like this. So I think also that small caps will benefit from people being a little bit more confident in the markets, because we've had this play of everyone going into Nasdaq, and I mean, as a defensive kind of stay-at-home play, I get it, sure, but I'm not. I think we're in a similar camp, although I see you loaded up on Amazon and so on. But when I see, no matter how good the business are, if I see 60 to 90 PE, it's a red kind of flag for me that something bad can happen. I'm not saying it will happen, but I think once we reopen fully, and people will kind of leave maybe a little bit of Nasdaq and Moderna and other stocks, I think that's where this confidence in the market and the liquidity will benefit the small caps as well, because now it's a little bit, okay, well, it's kind of risk off, right? We don't want to risk too much. Maybe let's close China, let's go small cap and go into tech. But once we have the confidence really back, because now we have Delta variant, we've almost been there, but now with the Delta we're coming back. But I think once people will really get the confidence, the small caps will really go quite nicely. I've seen you've been buying TNA as well, so that's interesting.
I have, yeah. I think there's been a lot of volatility in the small caps index, and I've tried to play with it a little bit, and it's worked quite well. And I think I'll keep it for a little while. I think we're bottoming at the moment, and it's gonna, whenever confidence returns, it's gonna skyrocket, I think, this one.
What do you think of China? Because I've seen you've been carefully treading the water and slowly taking some positions. The famous Q-fin that we sometimes discuss on the group, obviously kind of catching a falling knife there. But what do you think? Do you think long term is interesting, or you just like better opportunities in emerging markets or somewhere else?
Yeah, I like China a lot. I mean, a lot. There's a lot of risk, but I think if you take a really long-term approach, I think I like it a lot. Q-fin I got in actually in February, March. So I had a sort of 50% profit, trimmed off a bit, and then it went back down, and I bought back a little bit too early.
Yeah.
And that was a bit of a mistake. I think the way I'm approaching China is there's a lot of asymmetric risk. They can destroy one company or one sector just at a click of a finger. And that's a risk. So the way I want to deal with that risk is looking at the really very big, very large mega cap in China in the tech space, and think, okay, which ones are really critical from a strategic perspective to China, And I think, for instance, Alibaba is a company that they just can't afford to sink.
Sure.
It's become so ingrained in the economic system. It's so necessary that they can't sink it. If they destroy Alibaba, I mean, it would be a complete economic disaster. I look at a company like Baidu, and it's kind of the same. It's a company that has
Yeah.
become really strategic, really fundamental
Mm-hmm.
for China.
Mm-hmm.
So they won't touch it. I don't think so.
Yeah.
If they do, it's going to be at the margin.
Mm-hmm.
So I think that's the first way to deal with the sort of like Chinese risk is like focus on the sort of heavily discounted, very
Mm-hmm.
strategic mega cap, and then an index play. I have the EM ETF,
Okay. Yeah. Yeah, I've seen
um,
that. Mm-hmm.
and I'm going to build it further. I think because obviously there's a lot of companies in there. So if a couple of them get hit by regulation, it doesn't really affect the index so much.
Sure.
Um,
And this is one, it has a heavy tilt toward China, but it has other countries as well, right?
yeah, it's like I think it's around 30% China, and then you have a bit of Taiwan,
All right.
India, Brazil, Mexico.
That's
I like
great.
all of those countries. I think
Yeah.
they've been hit by COVID, but they're gonna
Sure.
have a good
Yeah.
decade.
I hold India and Brazil in my portfolio about
Mm.
2% each, and I've been happy with it. About 30% up on it now, but I feel a little bit more confident long term there than maybe the US indices.
Mm. Valuations are really attractive, and you mentioned the UK. I think is another one.
Yeah.
The UK is one that's really interesting. I haven't found my angle yet, but valuations are
Mhm.
really attractive at the moment, and I know you've done well there.
Yeah, I've been very heavy in the UK since the beginning, really, of my journey on eToro, and I've always been a little bit more tilted towards Europe, and UK has stayed. I mean, the now Capita is growing, for instance, today, and Aston Martin is still good value, and Rolls Royce is growing as well. So, let's not forget. Actually, UK is one of the most. It's probably the most global market in the world. If you look at the revenue
Mm.
distribution, UK versus outside,
Mm.
it's a very global market.
Mm.
So people should not make an assumption that okay, we have a bad management of COVID and we have Brexit, and therefore UK is supposed to be so low. Actually, it's just a very global market. So you should maybe not. It's not Nasdaq. These are not the same. I have few tech companies there. They're not Apples or Googles, but these are solid companies working for governments, and Capita is at 600 million with 3 billion revenue. There's this kind of things,
Mm.
and you have Micro Focus that's similar, and they have few other. So again, for me, for my style of investing is I feel safer, to buy something very undervalued, and like you said, keep 30, 40, 50 stocks like this, and then some of these markets really, really catapult. So we're bullish on the second half. So you think the outperformance will come from small caps in China and emerging markets?
I think so, and I would add UK to that too. And I'm looking to get into the UK. I just haven't found my angle yet. Yeah,
Okay.
I think so. I think it's as you said, people have come back to like big tech for sort of like safety trade,
Mm-hmm.
and that's gonna rotate again. I think they got worried about the new variants of COVID. They got worried a little bit about the lack of momentum in small caps, and they sort of went for safety. They went for bonds, and they went for mega caps. But I think, and you see, Amazon was maybe the first one to sort of draw a
Mm-hmm.
line in the sands, like, okay, from now on, growth is going to come down.
Sure.
And Facebook said it too. And I think you're seeing some of the results of smaller tech companies, and you see growth coming off. So I think that
Mm-hmm.
sort of like safety trade into tech is gonna die soon,
Sure.
and
I
we're
agree.
gonna go back to more cyclical trades because the economy is so hot.
Yeah, I agree. Even to the point that I open a leverage short on Nasdaq. I personally think it's too soon. I'm not saying this is the one, but
Mm.
I like it as an insurance. Because we've seen 7% drops in Amazons and the like, right? So
Mm.
so this is serious. And personally, there's another thing that I think market has not priced in, is this global tax pressure.
Mm.
And these companies will pay. I'm based in Luxembourg, and companies like Microsoft, Skype, and Amazon, and they're all here, and
Mm.
in holding companies. But this will probably be more difficult going forward. And if you go from paying 5%, 10% to paying 20%, this has a big impact on your bottom line, right? So,
Mm.
and I think the big tech would suffer from this.
Mm.
So I actually, it's almost impossible to time the market, and especially shorting is difficult.
Mm.
But I have a high conviction short on Nasdaq, and I will probably every time now I see that the rally is a little bit, overstretched. I think I'll be opening this kind of outsized risk shorts where I'm highly leveraged, but if it goes the other way, I'm exit immediately with very, very small loss. Whereas if it goes my way, it will be interesting. But I'm pretty sure it will go from 15K to at least 12, 12 and a half, I think, and maybe lower. I remember I was quite bearish when it was trading, we had 9.6 before the COVID and 6.9 during the COVID. And then when we went about 9, my view was it will go down to 7.2, right? And it goes it's 15 now. And frankly, this PE ratios of those companies are about 2 times too high. And as you said, they are pretty safe. And I know a lot of hedge funds actually hold them. So they're some of the favorites for the hedge funds. So there's obviously big institutional money there, but I think it has to cool off a bit.
Yeah, I'm with you on that. And I think I might open my first Nasdaq short when I see signs that I want it to start going down before I open. I'm a bit risk averse on my shorts. I want to see it start going down, and then I think it's as you said. I think I'm looking at 12,000, 11,000. I think it's probably going to correct pretty hard.
Okay, that's interesting. So you think it's possible for us to, let's say, continue with a small cap but have the Nasdaq down?
Yeah, I think I could see a sort of strategy for a couple of months where I'd be long small cap and short Nasdaq. That would be really aggressive. But what I see in the data, what I see in the charts is quite supportive of that. So I might, if that gets confirmed, I might try it whenever I see the Nasdaq coming down a little bit.
Interesting. So we have exactly the same view. We must have studied too close to one another then.
Yeah.
Oh, interesting.
Yeah.
Okay, so what are we talking about? Favorite stocks now, or something else in between?
Yeah, let's talk favorite stocks. I think everyone's waiting for that now.
Yeah, you can start, and we can maybe take one by one. And
yeah. Okay. I'll do it like short term, mid term, and long term. That's how I think about it. Short term, I really like the travel sector. I think they've been hit a lot by the Delta variant, which doesn't seem to really be a danger. And I've been to the US, airports are full, planes are full. They're having to cancel planes because they don't have. They're having to cancel flights because they don't have the planes or they don't have the pilots or whatever. The demand is so strong, and people want to go on holidays. They want to spend the money that they've saved for a year and a half. I feel it. Everyone feels it, I think. We're vaccinated. We can travel, and I think we're going to travel. So I like Southwest Airlines in the US, and I like Booking.com.
Okay.
That's my 2 favorite travel plays. I think Booking.com is going to do well. And they've had really great results a couple of days ago. I started just before the results announcements. They got a 5-6% bump on results. Okay. I think short term is gonna keep going higher. Bookings are really strong. I've been trying to book hotels on the website for August, September. It's full everywhere. Okay. So that's why I got in actually. It's like I did my research on the stock, looked at the financials, looking interesting, look at people traveling, and then I tried to book hotels. Yeah. And it was full everywhere. It's like, okay, I just need to get in.
Field research.
Exactly, field research. And I think that Q3 is going to be very, very, very strong. It's going to surprise a lot of people. So I see a nice 30 to 50% upside for booking to the end of the year. I like it. Yeah. And number 2 short term, I think Southwest Airlines. It went really high in February, March, and then sort of cooled down. And it's typical where you see the stock going down, whereas the data is going up. Like travel in the US is back to pre-pandemic. Everyone is vaccinated. Everyone, less so in the US, but a lot of people are vaccinated and traveling. And meanwhile, the stock keeps going down. So I think that's another interesting opportunity there.
Okay, cool.
So that's my number 1. What's yours?
That's number 1. Yeah. So I will also divide it into 3, but not in the same way as you. I will put it into China, UK, and small caps. Okay. So I'll divide it into 3. This is also how my portfolio is created. So let's say I'll take China. Well, I like, some of the things I have a forward P of 2, and so China Railway has 1 trillion revenue and below 100 billion market cap. So you see some of those things, or Doyo or some of the real estate companies in China. They have more, 2-3 times more cash than their market cap. So I'm sitting on them thinking that if people just wanted to invest in them, they could double or triple in a day, and they will still be half price and things like this. So I quite like China overall. I like Baidu, like you said, the mega cap. Today they announced, I think, like an electric omnibus, something, kind of multi-purpose bus that's gonna be electric, and whatever they do, they're very advanced in robo taxis as well, and people don't think about them as they do about Tesla, but these companies have huge resources, and China is really the number one in EV. So I think that should be interesting. And if you look at what Google has done in the US, and how important China is, and Google is no longer in China really, so Baidu has a kind of free. Obviously, there is a little bit of risk about the government, but like you say, these guys are systemically important for the country. So I like Baidu. I like Vips a lot, which is like a bit like Etsy maybe. It's like a trendy Amazon, but amazing. This is obviously amazing part of the market, and I love the margins and so on. So I'm largely exposed. Yadea is my biggest position there, which I kind of like, and I'm not really a growth investor, but at these valuations, I'm happy. And it's a company that partnered with Porsche, for their electric scooters. So if a Chinese company can, partner with Porsche, that kind of tells you a little bit of a story, and they're basically at half price. So that the China overall is my number one, and it feels difficult I'm not increasing the exposure there anymore because I've heard enough, but I think if you extend the time horizon to 6, 12 or 36 months, you will do extremely well.
I think so too. Yeah, so, no, I agree with that. I had zero China before July, and I got up to I had a bit of QFIN, but 1%. And I got up to progressively 6, 7%. I might increase to 10%. It's gonna do well, I think.
Yeah.
All right, number two, more midterm. I like Ferrexpo. It's an iron ore miner based in Ukraine, and it's the third largest exporter of iron ore in the world. It's correcting a little bit at the moment. It was like over 500. Now it's coming down to close to 400, the share price. But it's done extremely well. I bought it like 9 months ago, and it was trading at 200. So I've done more than 2 times on this one already.
Great.
It's essentially a cash machine at the moment. They're printing cash. It's iron ore has increased a lot in price over the last year or so because China is consuming it as crazy, producing cars, bridges, houses, everything to the world. And so price has gone up a lot. So it was actually so hot that China has been trying to do everything they could to control prices, including cutting production, which I think is a bit of a crazy idea because if you cut production, then other countries are going to pick up the slack, So absolutely. They're trying to manipulate price to make it come down, but they're not successful. It's just a silly thing to do, I think. And so at the moment, so they've announced results last week, and they were incredible. I mean, they were incredible. They have a current dividend yield around 15%, around 5%. Okay. They're trading at around 5 times last 12-month earnings, which means that the market is pricing a significant drop in iron ore prices, which might happen in the short term because China is trying to manipulate it. But I think over the medium term, the sort of like natural supply and demand dynamics would just come back to normal, and you'll see that price kind of stabilizes at a pretty high level. Because yes, China is cooling down, but now Europe is producing cars, houses, and everything like crazy. Same in the US. car manufacturing is picking up a lot because they're starting to have components again. The housing market is starting to get really strong. So I think the sort of deficit that we're going to get in China is going to be more than compensated elsewhere. And Ferrexpo is really a nice position in the market because they're really focused on the higher quality mineral, which means that with those higher quality iron ore, you can essentially produce more efficiently, which means less pollution, which is critically important, especially in China. And it means greater productivity, in your productive process. And Ferrexpo is sort of like leaders in that segment of the market, which is enjoying higher and higher premiums over normal iron ore. So in summary, I think you have a company in Ferrexpo that is valued very, very low, 4 or 5 times earnings, whereas competitors like Rio, Tinto, Vale, are trading more around 7, 8 times. Their position right at the sweet spot of the market, which is higher grade iron ore, less pollution, so much more demand. And essentially, there's a sort of like temporary, I think, short-term correction in the price, which would be, I think, a good time to start building a position for the medium term, when we'll actually realize that the economy is still strong, and so prices of iron ore sort of plateau at a high level.
Super interesting. I was actually looking at this, that in your portfolio, and for me, it's not really my sector that much. And for me, the geopolitical risk of Ukraine would kind of create a little bit of a, if I buy Rio Tinto, I'm a little bit more, okay, I know what they're doing, how they're doing it. And obviously I would have to look up, because probably Ukraine is a very low revenue breakdown, but I'm quite surprised to hear that being based or headquartered in Ukraine, they're actually high end. It's more like thinking Swiss are high end and not Ukraine. Yeah. So it's very interesting.
Yeah, it's an interesting one. There's political risk, and also the number one shareholder is sort of like might be going to jail at some point, which is not great for the stock, but is not involved in the running of the company. But I think for Ukraine, it's a critical asset for the country. They can't afford to screw it. As I said, it's like the third largest exporter of iron ore in the world. Right. So it's really critically important for Ukraine. And it's managed out of London. So the assets are in Ukraine, but the management is done from London.
And they're listed in London.
And they're listed in London with a premium listing.
Okay, that's great.
It's an interesting. I think they get a big Ukraine discount. That's why they're trading at 4 or 5 times rather than 8 times.
Sure. Yeah.
And depending on how you look at it, it's a risk, but it's also an opportunity.
Sure, absolutely. Yeah, it sounds like it's a little bit undervalued because of that. And I talk from experience when I worked for a kind of Eastern Europe company, and I was presenting in Switzerland. The questions I would get, like, why your major shareholder is this and that person, and they a little bit more, like if you look at China, that's also because of that, right? People are not used to the fact it's not priced that China is a superpower and the companies will be worth a lot. Yeah. And I think people forget that it will happen, and even if they put regulation on them, it's not a bad thing maybe long term, because they need to increase the reporting standard, they need to increase the corporate governance. So it's actually good if you build a global business. Yeah. But I think I will look into it, especially in the revenue breakdown, and it sounds very, very interesting.
Yeah, it is.
I'm loving it. So thanks for sharing. I mean, we had a similar session in Barcelona when you can, it's a completely different thing to see something in your portfolio and hear you explaining, your analysis live. So that's great. So shall I move to my number 2?
Yeah.
Yeah. So I will say UK. So maybe it will be helpful as well for you as you want to take an angle. So as I said, I think UK. I remember when I was in Portugal before we met in Barcelona, and I woke up one day and the UK was 3 or 4% down. It was on Brexit talks, and it looked like there's a third world war. I used my Bloomberg and my Reuters, and I had P's of 3, 4, PEGs of 0.2, and kind of 5 times bigger revenue than the market cap and things like this. And I would compare like for the American, and there will literally be a factor of 1 to 10. where you have UK maybe third of a price, and then US kind of 2 times more, pricey. And if you look really like for like companies that have global, revenue breakdown. So I used to love Micro Focus. They went down recently on some Amazon related kind of contracts because it's a big part, but they're trading at about 400, and they used to be above 1,500, and they're probably worth, 600 is, I have X5 on my private and I cannot see it trading below 600, which was there before. And now I have Capita. It's one of my biggest position. It's been growing, I think 8% over the last 2-3 days. They just reported earnings normal, but if you have normal earnings and everything is fine, and you're trading in 1/5 to 1/6 of the price you were just before the COVID, there's something wrong here. And Barclays just said they initiated the coverage and they said 80, and it's trading at 36. And and again, this is not China. I'm maybe regretting a little bit that I could have put even more in the UK, and I put too much into China, so my stats suffered. But so I like Capital Micro Focus because they are tech, and if you look at Nasdaq multiplies and these tech, you probably like it as well, because this is the sector that you know quite a lot about as well. It's really, really attractive, and I'm very bullish on Shell. So I used to be my biggest holding, and this is a very safe one. So like you like them. The conservative estimates are that they should be about 2,000. They're trading at 1,500. So there's like a 30-40% growth without any risk. And one of the private bankers here I spoke about, he was also his biggest position, and it's just kind of a safe play. And I've obviously done Aston Martin a lot. I spoke about it on all my channels, and still they've just delivered 224% growth in revenue on this year, and their SUV is selling like hotcakes, and they're valued at I think 2.6 billion, but again the brand value is 5 billion. So there is still I think the estimates are 2.8k, the kind of conservative ones, but I'm very bullish on it long term.
Yeah, so we talked about it, I think, when we met in Barcelona. That's the one that was my worst trade of last year. I got burnt on Aston Martin.
Oh, you did?
So I got in just after Stroll to cover the company. So I bought it. It was before the split, so it was 50 pounds at the time. And then they had the sort of first earning calls was terrible. They had a CFO which was very uninspiring.
I remember that. Yeah.
Bad management team, everything is just it's like, okay, there's no future with that team. So I sold the next day, and then a week later or so they announced that they're changing completely the management team, and then everything went up from there. And I thought, based on the information that I had, it was kind of the right decision to sell, but then everything changed right the week after. So
Lawrence did a great job. And actually, when I was short, I shorted it from 284 to 8 up all the way to 83, so 3x short, and it was my first trade on Aston Martin. And it kind of shows how I approach the stock market as well. Even though I love the company, if I think it's overpriced, I would short it. We should probably talk about Tesla short, but maybe that's the next episode. But
short idea is the next episode.
So it's still a good one. I'm thinking the way to think about it is that brand value is about 4 or 5 billion before Formula One. And Lawrence Stroll comes from fashion, so they have a very good marketing and branding and fantastic partnerships. And now they're turning almost I think $1 billion in revenue if you take a pro rata earnings, but they want to have 2 billion I think by 2025 with 500 million EBITDA. I think that's the goal, and 10,000 units sold. So very professional. This is a high level, it's a billionaire guy. So everything is like we like, they have a transformational plan. These are the cost savings. This is the EBITDA. This is the revenue, and they're delivering against it. And the way to think about it as well, I think you're still a good time to join, is that the SUVs are really the cash cows for those companies. So when Porsche introduced Macan and Cayenne, now it's over half of their sales, and this is really the cash, not the nicest for the car enthusiasts, but for the balance sheet, these are really killing it.
Yeah, interesting. Maybe I look into it again. But as I said, I got burnt on that one.
Yeah. All right. So
All
what's
right.
your third?
My third one, so longer term, I like US home building. In particular, Taylor Morrison, that I've been selling quite a bit. And it's a sort of like, ever since the great financial crisis, which started as a housing crisis, right, housing bubble, the market has been, I mean, the market never recovered essentially in terms of, volumes and in terms of prices. And so you arrive at the point where there's a lack of, I think it's around 8 million homes in the US. There's a dire shortage of houses just because the industry has been very prudent for 10 years. And so on top of that, you have the sort of like millennial generation coming of age, getting in their 30s, and they want houses, they want to start families. In addition to that, you have the sort of like whole move outside of the cities towards the Sun Belt. People who want to move to Texas, to Arizona. Um, you know, low taxes, sun, quality of life. And so there's that sort of like move that's taking place, and I think it's going to continue to take place over the next decade or so. And so you look at the sort of like demographic trends, and you look at the lack of supply of houses, and you realize that actually the US needs to build 2 million homes a year for 10 years in order to match supply with demand. It's huge. It's incredible. And so far they haven't done it because they've been overly cautious since the financial crisis, because financing was a bit difficult, and because the sort of like zoning restrictions that they have kind of make it painfully from an administrative standpoint to build homes. And I think they're kind of taking action little by little on all of those pain points, if you want, which means that you can see like house building starting to pick up again in the US. And so you have a player like Taylor Morrison, who's valued at around 6-7 times earnings. It's very low, Granted, it's a cyclical sector, but still 6-7-8 times is like way below historical averages in terms of valuation. I mean, Taylor Morrison are valued at essentially at book value, which is crazy, because what they have in book is inventory essentially, which is land and houses being built. So the actual value of that is much greater than what's on the balance sheet. Balance sheet is at cost. The actual value, the sales value of that is 30% higher. They're guiding towards return on equity of 20% on that book value, which is huge. It's huge. So they should be, if anything, valued at 1.5 times, or probably more than that. So you have a sort of like already sort of 50% valuation gap versus where they should be today. If you add to that the sort of like growth that I'm expecting for the next 10 years, that you could do 2, 3, 4 times on that stock over 5 years easily. So I really like it. I think it's a cyclical sector, right? House building, it's always been. But if you take a sort of like long-term 5 to 10 years approach, I think it's a clear winner, and you have a lot of margin of safety in the valuation. I mean, it's really low. And I'd say, as a second way of deal with the industry, you can look also at distributors of materials, lumber, roofing, windows, all of that stuff that you need to build a house. You're sort of like further down the supply chain. But it's a really good place to be, because they have high margins and they don't care about inflation. Inflation is good for them because it means that they can sell at higher prices and make better margins. So if you're not comfortable with house builder, then look at distribution, and you have a company like Builders First Source that I have. That's also really interesting. Great margins. They raised guidance yesterday, doing really, really well. A bit less undervalued, but still good opportunity there. Solid companies there.
Fantastic. I kind of stole / borrowed that one from you, because in Barcelona there was one that I think stuck with me the most. I like the macro view from your perspective, and then when I look at the books, I was quite surprised. It was really like you said, about 50%. Now maybe it's still 30%, 35%. kind of below anything that you can, you must be trading at 32 or so. Like anything below is a big bargain. And he was aggressively selling out. Remember, I kind of caught the falling knife at it, and then doubled down. At some point, it was almost my biggest position, because when I started building it, it would, just before the earnings, it was aggressively going down. So I was kind of averaging down, and I was like, well, this is a great, a great investment. But why is it falling down? And I kind of thought, okay, this kind of 28.32 is an absolute minimum. So I've built a position. I sold half of it to buy other things, but the one that I picked the lowest, like, I'm keeping, and I think it's great. But also shows, it's not so easy to borrow someone's ideas. I think we've both seen that some of the older people, or be it PIs or copiers, are trying to do that, right? Based on our portfolio, it's a normal thing to do, I guess. But it's not so easy then to trade, because if I'm trading Aston Martin, I know exactly every level where it goes, whereas if I maybe go to TMHC, I can maybe go too quickly and so on. You don't feel the stock the same way. But it's certainly a good one, and I've invested on it based on kind of our conversation and the books, because the books look really cool. And I have TBLT, which is a very small cap play in kind of do it yourself and so on. But the results are amazing, and these guys, I think, are trading again a bigger revenue than the market cap, and then but with great partnerships as well. So very interesting.
I like it. I think I can't buy it because I have too much AUM now. But but that's a good one. I like it.
It's an interesting one. So actually a segue to my third, because it is going to be small caps in the US. Well, eToro, it's mainly US, right? That we cannot really buy small caps in other countries. But so TBLT I would mention, and another one is Boxlight. It's my favorite now. And both of them are trading almost 1-to-1 revenue to market cap. But if you look at projections of Boxlight, I think eToro shows 82 million in revenue, but it's going to be 157 reported now based on projections, with 110 million market cap. So and then fiscal year 2 is, I think, around 200 million. So they have to go to a valuation of around $1 billion at some point, which is 10x from now, right? Well, unless they dilute the shareholders a lot, but there's still a multi-bagger, as we call it, right? And it's this one is I would say the safest one. So at the moment, it's my biggest risk exposure. I've just built a bigger position. Goldman Sachs built a 3.5 million position in it, and it's trading at 2 with a price target at 6. And again, this is not very risky, because if you go from 80 million to 150 million to 200 something million, and if you look at the news, I think I've never seen anything like this. For the last 2 months or so, there is amazing news after amazing news from all around the world. South Africa, New Zealand, Europe, and they just become a partner as well of Google, and and the market is just not moving because it's a small cap. So it's like, we know how it works from the institutional standpoint, right? It's a small cap, too small, even for you, too small, right? So you cannot invest.
Probably.
They're totally neglected. I also saw that I had to build very small chunks. Now I cannot buy a normal amount, so I had to really divide it because of liquidity. But so I think 3 of my favorites here are Boxlight. I think it's like a safe small cap, like based on what. Then there is IRO, which I love. It's like an EV, but kind of very practical utility vehicles, like small, think of a kind of golf cart, electric golf cart, kind of small cars where, now if you go to Madrid or Paris, this is kind of the fleet that they have, and people move. And when I analyzed actually at HBS, I wrote a paper of Tesla versus those kind of vehicles. And my conclusion was that these vehicles who really win, because they're just so utilitarian. And and they even deliver some vaccination vehicles, to distribute vaccines, and a similar case, even bigger. If you look at projections, they're I don't know, 2-3 million revenue, I think now, or 5 or 10, nothing, but they go like 250 in a year based on the contracts already signed. So it's not, out of the blue projection. So based on kind of this data, then I know, okay, well, this company should multiply. And I think people don't maybe have the tools to know the projections. Maybe they don't look 2-3 years in the future. But if I know that they already signed, for me, there's almost no risk. Obviously, volatility of the share price is the risk, but they used to trade at 12 and now they're trading at 4. It's actually my biggest position in my private account. And then the third one will be EVFM, which is like a gel for ladies, contraception thing. And if you look at there, the revenue goes like 200% a month because they made this big marketing campaign, and there are no hormones in it, so they kind of ladies are a little bit more conscious. They all like this because it's safer, healthier, and so on. So, but this one is quite heavily diluted, which I hate for the small caps. Every time they can, they raise the capital and then they dilute the shareholders. So that's why the price is down. But it's trading at 0.8, and it used to be $5. And again, when we have, I think even on eToro, when people see the updated revenue, it will create a lot of buyers because people will realize, whereas they don't really, obviously, if you look at Amazon, Apple, everyone looks into every single metric, right? But if you look at the small caps, people don't really perform due diligence in the same way. Maybe, I don't know what's your point of view, but maybe also because a lot of institutional cannot even buy it because it moves the AUM so much. So
I think so. Like institutional can't buy it. There's not a lot of investment research about it, or none at all sometimes. So it's a big question mark. And I think what you need is sort of retail people to catch up with the reality of the business.
Exactly.
And then when that happens, then you get what happened in January or February this year. The stock triples in a matter of weeks.
Yeah. Hopefully we'll have it in the second half. So I get back to the highlights a bit more.
Yeah. I'm very confident. I mean, I've doubled on small cap in July, and I wouldn't do that if I wasn't confident.
Great. You'll be increasing the TNA, or you'll be buying some specific stocks?
I've sort of like tidied up the portfolio a little bit. So I went down to 35 stocks, which is I'm more comfortable with, like 35 than 40. I think 35 is a good number. I invested more in the home builders, and now I'm sort of like, I've got like 5% of cash, 5, 6, 7% of cash, and I'm waiting for the right timing, the opportunity to go. But yeah, I think the extra cash I have is probably going to go to small caps.
Okay, cool. Good stuff. Okay, shall we wrap up here?
Yeah.
How do you want to finish, Hugo?
No, I want to thank you for your time and your ideas. I hope that my copiers and your copiers enjoy it. I certainly did.
Yeah.
And
my pleasure, Hugo. It's always so much fun to discuss those with you. I think we could do it for hours, and so let's come back to that at some point. And I'm looking forward to your first short.
Yeah, and we should definitely do a top 3 short ideas call in a while. I mean, you're the king of shorts on eToro. I don't think I can compete with you on that. I mean, like Tesla's gone parabolic for like 1 year now, and you've probably been the only guy in the world making money shorting Tesla.
Yeah,
it's been really fun to watch.
It's been fun to watch, and it attracted a lot of eyeballs. So I'm waiting for it to cross 800 to see when I can short it again. So
okay, all right.
Oh.
Okay, well, it's been great, and I'm looking forward to our next catch up. Top 3 short ideas.
Likewise. Thanks.
Time.
See you all soon. Take care.
Take care. Bye.